Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and I am joined here once again with Jessica Inskip, our Director of Education and Product. And today we have a very diverse and broad set of topics that we want to discuss with you around best practices for trading options. Whether you're brand new to options trading or you're just getting started, you're going to learn quite a bit across the board with respect to trading options from a directional perspective, generating income, as well as things like assignment risk. And those are some of the things we're going to discuss. So regardless of where you live on this, where you are on the spectrum and in terms of experience, hopefully you'll be able to take away something from today's session. So with that, I will hand this over to Jessica, who will kick this off. Jessica, thank you so much for joining us today.
Yeah, thank you, Tony. All right, so like Tony said, we have a very diverse set of subjects today, just going over some best practices when trading options. So this really is something relatively beginner. You do have a prerequisite of just knowing the strategies, and from an individual basis, we'll cover that. And we'll just go over some of the tools and resources that you have available and best practices when trading options in the markets today, really. Before we get started, I want to always give you an important disclaimer. Types of securities, forms, and research tools used in this video are for demonstration purposes only, should not be considered a recommendation by OptionsPlay or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Do you have a quick question for everyone? We got a chat that there's a horrible echo in audio. Is the audio okay? We had a little bit of tech issues prior to coming in. All right, thank you very much. Looks like it's great. All right, so let's go over what we're going to cover today. So we'll review an option. So we'll go over the types of options that are available, like I said, on that individual basis. We'll talk about choosing strikes and expirations, and we'll talk about the risks and the best practices, and we'll have Q&A, and we'll spend actually a lot of time in the OptionsPlay platform going over the tools and resources that are available so you can really apply those best practices. But the real takeaway today is, what are the risks and actions I need to be aware of when trading options? So again, if you've started just trading options, and we're going to go through some of those risks that you need to know, or those lessons that you learned the hard way. One of our missions is to make sure that you never learn those lessons the hard way, that we always get in front of that so you have the best practices available. And if you've been trading options for a long time, it's still something really great to understand and be reminded of. So quick review of what an option is. An option is essentially a contract between a buyer and a seller. So just like with any contract, there is somebody who is the buyer who can execute on the terms of the contract, and then someone is selling that contract to you. The buyer pays the premium, the seller receives the premium, and in the case of equity options, it's executable at any time for the time frame that is specified within that contract. So on this example, we've got that this contract represents 100 shares of ABC at $100 per share, and that it's executable at any time until the expiration date of May 20th, 2022. So if this was issued as a call, that means that this contract would represent the right to buy 100 shares of ABC at $100 per share. If it was a put, it would simply represent the right to sell at $100 per share. And then whoever bought that contract would be able to execute upon the terms of that contract at any time. They're the person who can make that decision. The seller has the obligation to fulfill the terms of that contract. So in the case of the call, the buyer has the right to buy, the seller has the obligation to sell to the buyer. And in the case of the put, the buyer has the right to sell, and the seller has the obligation to buy from the buyer. Not directly, but there's a whole process that goes along with that. But from a conceptual basis, that's extremely important to know. And then in between, the buyer pays a premium. They are the ones that can execute upon the terms. So normally from a long option perspective, that's the max you can lose. And the seller, they don't want the contract to be executable upon. They just want to keep that premium. And so that's important to know. So this is extremely important concept to know when you're trading options, period, but it's just the foundation that we want to make sure we cover before we go on.
For those of you that might be newer to options trading, if you find this kind of legal jargon a little bit confusing, it's okay, because it kind of is confusing legal jargon. Ultimately, it is a contract, and what we're talking about are the terms of the contract. But hopefully today, during today's session, what we'll be able to do is give you a much more practical approach to these option contracts, understanding why you would want to be a buyer, why you would want to be a seller, and talk about some of the strategies around when you would utilize these in more practical terms.
Absolutely. All right, and this T-chart that I'm sure you've seen before, but we love showing to you just because it's really great if you're starting out with options, or as a great reminder, even if you're seasoned or a master. We put this together to really equate to even the Greeks, but the purpose of it is if you just focus on long calls, this is everything else is a mirror. So when we teach in a lot of our other videos that really go into the foundations and the essentials of options, that's the way we teach it, is if you know a long call, then you can really figure out everything else because it's a mirror. So let me explain to you what you're seeing. Much like an option chain, calls are going to be on the left and puts are on the right. We put long calls on the top and short puts on the top because both of these are bullish. So anything in this top quadrant is considered bullish. And you notice what is common with both of these strategies is they contain a buying transaction of some sort. So the long call is the right to buy, the short put is the obligation to buy. And both of these are bullish strategies. And then the inverse is also true. So you can see the mirroring effect across every bit of the quadrant, if you will. We're not going to go into the specifics of what every single one of these are in an individual slide, so I'll spend a little bit more time on this. But you'll see how the long options, or each long option, is purchased for a premium, like we were equating to the previous slide. Those are the option holders who have the right to execute upon the terms of the contract. And if you remember the options pricing webinar that we put together a little while ago, and we'll make sure we add a link to that as well. But options are made up of primarily two components, they're premiums, that is, which is intrinsic value and extrinsic value. Intrinsic value is the actual value that the contract contains, which is the executable value of the contract. So if we have that right to buy ABC at 100, ABC's at 110, that contract should be worth at least $10 per share, because I can execute upon the terms of the contract and buy at 100 and sell at the market at 110. So that's the intrinsic value, which is just the actual value that the contract contains. Anything in excess of that is extrinsic value, and that's primarily comprised of time value. So the longer that your option has until expiration, the more expensive it's going to be, which is rather logical because you have more time for it to move in your favor. Therefore, it's going to be more expensive. And then the third component of pricing, but second component of extrinsic value, is implied volatility. And that's the likelihood of market movement in either direction. So think about earnings. That's a wonderful example of how implied volatility works. We know that the earnings are going to be announced at a date, and we know that we want it to hit analyst targets. And if it's greater or less than anticipated, the stock is going to move drastically in either direction. And because there is a highly anticipated movement, there is high IV, and that will make the option more expensive. And that's something that is can benefit you in a lot of different ways, depending on what side you are. And we'll talk about that as well. But with all of that in mind, with how an option is priced and how the contract is made up, or the anatomy of an option, that's what these goals are intended to reiterate. And you'll notice how it absolutely is a mirror. So any long option that has the right associated with it. So if it's a call, right to buy, put, right to sell, time decay is negative. I need to overcome time because that's decaying and it's working against me. So that's something to be cognizant of. So if I buy a call, I also have to know that if I hold that option until expiration, any time value that I purchased or extrinsic value that I purchased, that's going to immediately leave and it will be gone at expiration, which means they both profit from a sharp movement in their ideal direction. So right to buy, sharp upward movement, right to sell, sharp downward movement. And you'll notice how even with the mirrors on the goals, anything that's short, you still have a directional bias, but it is also neutral. You can still reach maximum gain if the stock doesn't move at all. And that's because time decay is positive for short options, because as the option moves closer and closer to its expiration period, that extrinsic value component is going to decay. So you actually don't have to overcome that for your short option, but your risk is the sharp movement. And that's something that equates to risk, which really we just explained all the Greeks to you and without saying what they were in a way. But that's what's important about this chart, and what's important about really understanding the mechanics of options, and why we like to show this to you over and over again. And it's something that's really beautiful with the logic of options. It doesn't matter what terminology we say, what legal jargon we say, or how, if we call something a jade blizzard, an iron butterfly, or a Christmas tree trade, the options are going to do what they're going to do, and that you can capitalize on that as long as you understand these basic components. So that's a really important foundational element that we want to make sure you fully understand, because this is what we're going to utilize to define our best practices. All right. So with that in mind, normally when you're first trading options, you tend to fall in either one of these buckets. You're either seeking income or you're gaining directionally. And so that goes with these base strategies here. These are directional, and these are seeking income because I'm collecting a premium or I'm paying a premium. So if I'm paying a premium, I need sharp upward movement to overcome time decay. If I'm receiving a premium, I really don't want sharp movement because that's risk for me, but time decay is positive and I still benefit if the stock or the underlying remains the same depending on where my strikes are. So they can be layered together, and you can get, and Tony will cover that as well, but what's really great about options is you can structure them where you can get the best of both worlds, utilizing the obligations that are inherent of short options and the rights of long options. So ideally, you do a mix of both, and we'll talk about when you should do both and the tools and resources that will help you identify when you should do both. But here's a couple of strategy examples that align to the type of investor that you are. So seeking income, most common strategy is covered calls. That's, I think, the most traded strategy that's out there. I haven't checked statistics on that in about a month or two, but I'm sure it's still up there. And then cash covered puts, as well as credit spreads. And credit spreads is an example of utilizing long options to define risk, but still having a strategy driver of your short call or your short put. And then the opposite or similar for the gain directionally, you've got long calls and long puts. So it's just anything that you're buying. All of these are being purchased. There is cash received on this side. If your goals are neutral and directional, for gaining directionally, it's purely directionally, and it's normally sharp directional movement. Your ideal outcome when seeking income is decreasing in value, because like shorting a stock, you're selling, collecting premium, you want to buy it back at a lower price or just have it expire. And when you gain directionally, you want it to increase in value. So that gives you an idea of where you want the stock to go. Does that all make sense? I want to make sure I do those checks, and Tony is much better at me than making sure that we do those checks. But if that all makes sense, that's the foundational elements that we really need to understand before we move on. So please type a 1 into the chat if that's clear. Lots of ones. Great. Perfect. All right, Tony, so I'm gonna hand it over to you. You just got to unmute yourself.
Sorry about that. I'm actually going to share my screen, if you don't mind. So let's talk a little bit about selling options for income, because we all at this point largely conceptually might understand some of the basic strategies like a cover call or a cash secured put, but When it comes to the actual practical element of selecting what expiration date and strike price should I choose, when you look at an options chain and you see that there are expiration dates that span from 1 day to 729 days out, you see strike prices on stocks like Apple that span from $30 all the way through $260 when the stock's trading at $138. How do you go about selecting which strike price and expiration do you use for selling, let's say, a simple option strategy like a cover call or a cash secured put? So let's do a bit of a thought experiment here. We're going to use the OptionsPlay platform, and we're going to come to the income tab here on the right-hand side. When we use the income tab, it's going to ask you a question. Do you own shares of Apple? And for this purpose of cover calls, we're going to select yes. We own 100 shares of Apple. Let's say we own it at the current price of the stock. And the question is, if you're selling cover calls, which one do you want to look at? Let's look at July. We have, let's say, the 145, the 150, 152.5 calls. Now, just as a bit of a thought experiment here, please type your answer into the chat window as to if you were to select a cover call expiring in July. This is for an option that's roughly 30 days from expiration. What strike price would you choose if you had the choice of selecting strike prices? And just to kind of clarify, the 145s will give you about a 1.29% return or static return on the cover call over the next 22 days. The July 150s will give you 0.79%, and the 152s will give you 0.3%. So 1.29, 0.79, and 0.3%. Which strike price would you choose if you were selling cover calls on Apple, let's say expiring in July? Type your answer into the chat window. I see a lot of 145s. I see a lot of 152.5s, and I see a fair amount of 150s. I will say this is probably the most split that I've seen of these types of results. Usually the results tend to skew very heavily towards the 145s because that obviously collects a fair amount of income, right? 1.29%. That certainly sounds a lot better than 0.3%. Why would you ever want the lowest yielding opportunity here? Well, this is really where we've done a lot of research on this front. We've back tested this type of strategy across different expiration dates, across different strike prices, and we clearly see that when you're selling a cover call, one, you want to use shorter dated calls. So July, where you're about 30 days from expiration, that's a good starting point. But as far as strike prices go, you actually want to prioritize higher strike prices. In this particular case, the 152.5 call option, 152.5 calls that generate only 30 basis points in yield in this particular case, which is $41 in income, versus the 145s, which has $179 in income, or about 1.3%, 130 basis points. So you're basically generating a whole 100 basis points higher by the 145s. But why is that bad? Why does that give you a worse outcome in the long run as a cover call seller? The reason is because the difference between the 145s, which collects $179 in income, and the 152.5s, which collects only $41 in income, is that in that particular case, you're generating about an extra $100, $130 or so by selling the more aggressive 145 call. But think about what you're giving up for that extra $1 or $1.30 in this particular case. You're actually giving up, in this particular case, $7.50 in upside for the underlying stock that you own. Because if you own 100 shares of Apple and you sell it at 145 versus selling at 152.5, that's a difference of $750 for every 100 shares. So you're giving up $750 in upside in exchange for an extra $100, $130 in the short run. And that is a recipe that if you do this over and over again in the long run, you're going to find yourself in many occasions where you've given up way too much upside in exchange for an extra $1 or $2 on the front end. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you as to why, when you're selling cover calls, do not prioritize how much premium you collect, because the premium or the extra premium you make does not make up for how much you give up when the stock does rally. And hasn't been a good few months here for Apple, but next month perhaps you see a big rally here. Do you want to participate in that? I'm guessing the answer is going to be yes. And it's better off to say, I'm going to take $100 less premium this month and try to take an extra $750 in upside if we do see that rally. Even if I go a few months before the stock gets called away, I'm still going to come out in better in the long run by capturing that $750 in upside. That 1 month it does go up, then maybe the extra 2 or 3 months that I do get the extra $100, okay? So that is why when you're selling cover calls, using the income settings button here on OptionsPlay, I select short-term conservative so that I can collect as much upside as possible on the stock that I own, because that's the primary reason that I'm selling cover calls, is because I own the stock, and I own the stock because I think the stock is going to go higher. I don't want to limit my upside too much in exchange for an extra 50 cents or an extra dollar. It's very tempting to go for that cover call that yields 130 basis points versus 30 basis points, but you have to think about what you're really giving up. And most of the time, that extra 100 basis points, you might be giving up 500, 600, 700 basis points in exchange for that. And that is a recipe that in the long run does not make sense work out for you very well in the long run. Okay, so that is on the cover call side. Now let's shift to the short put side. If you were looking to acquire a stock at a discount, we know that short puts is a way that you can potentially have the obligation, as Jess was showing you in that T-chart before, that gives you the obligation to buy the stock at a specific price, but because you've sold the put, you collect income, and that income can be useful in helping you collect some premium that's going to provide a discount on the purchase of the particular stock. I'm going to use July here as well. So let's say if I was using puts, I'm going to choose short term as well. And let's say I was using, let's use a different stock. What's a stock that perhaps you think is maybe at a point where it's time to buy? Let's take a look at Netflix. Netflix is so oversold, and even despite all of this, it really hasn't moved lower over the past few months. Maybe you think that now it's time to start nibbling here on Netflix. Let's take a look at selling a put option here on Netflix. So Netflix is currently trading at 181. And I have three choices. I have the 170 puts, the 162.5 puts, and the 150 puts. The 170 puts will generate roughly 3%, 297 basis points. The 162.5 will generate 193 basis points, and the 150s will generate 90 basis points. So think about it as 3%, 2%, and 1%. Which strike price would you choose? Type your question into the chat window. Would you choose the 170s, the 162.5s, or the 150s? And a lot of times when I ask this question, I tend to see a lot more 150s, because you're kind of applying what you've learned from the cover calls, and you're saying that I should do the same thing here for the short puts. But I actually see a lot of you answering 170. It seems like that's a predominant answer here. And based on our back testing, that also is from what we have found to be the optimal strike for selling a cash secured put. You actually want to sell a cash secured put that's relatively close to the current price. Now, why is that? Think about that for a second. If you were placing a limit order to buy this particular stock, if you place your limit order at 170, what's your chances of getting filled? I'd say pretty high, because over the past few days, it's traded around this 170 price multiple times. You select the 162.5s. What are your chances of getting filled on that? I would say relatively low. We haven't seen that price at all over the past few weeks. And then if you really choose the one, I forget what the last one, 150s. If you're down here at 150, what are the chances of that getting filled? The chances are even lower. So if you're bullish on Netflix, in order to participate on that move, you must first get filled on the order, if you will. You must first be assigned and own 100 shares of the stock before you can participate in the upside. If you have an order down here to buy the stock at 150 and the stock just starts to take off, or even if the stock pulls back a little and then takes off, guess what? You're not participating on that upside, which is why when you're selling a cash secured put, the most important thing is to prioritize a strike price that has a relatively high probability of you being assigned on that, which in this particular case would be the 170s. And then you just simply have the added benefit of also collecting 3% of the stock's value by selling that cash secured put. So you're getting effectively a 3% discount on the stock purchase. And that discount factor is going to help reduce your net cost basis and just reduce your your risk here to the downside. And a lot of questions that I get from investors saying, well, how do you protect yourself from further downside? The reality is, this is not a strategy that's meant to protect you from downside. This is simply meant to provide a discount on the stock purchase, because if you're going to put a limit order to buy the stock at 170, you might as well put in a sell to put at 170, because that's going to collect $5.40. That's going to reduce your cost basis right off the bat from $170 to $164.60. So you're knocking $5.40 right off the bat on your cost basis, and that's going to provide these particular prices, a 3% downside buffer on the stock purchase. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so there's 2 different ways that you can use this platform to help you achieve this exact same thing I've taught you using the OptionsPlay tool. You can either use the platform itself. I have a watch list set up. So for example, if you want to use our momentum bullish watch list to find stocks that you think are going to outperform, you can use that type of watch list. We also have a cheap valuations and strong growth watch list. These are watch lists that you can potentially use to scan for opportunities for stocks that you might want to buy for selling covered calls, or potentially stocks that you might want to purchase using a cash secured put. There's a few different ways that you can use this. So for example, we look at the strong growth names, Canadian National Resources. Some of the names here, are a bit oversold here, and perhaps you're thinking now is the time to buy some of these names. You click on the income tab and you can select no, meaning you don't own shares of the underlying security, and it will present to you an opportunity. Now, in this particular case, we couldn't find a short-term aggressive cash secured put. So the next best available we were able to find is an August $45 put. So you can use this tool to help you navigate the options chain and understand where to start. Whether you're looking at a cover call or a cash secured put, you can just flip the toggle between whether or not you own these individual shares, and you can use the income settings to set your settings for both cash secured puts, for cover calls and cash secured puts. For calls, I select conservative strike price based on what we just showed you. And then for puts, I choose more aggressive strike prices. And this does the work for you. So whenever you're looking at a symbol, if I'm looking at Gilead, $62.50 stock, I go to income, it generates the July 15th $90 call option for calls if I'm selling cover calls, or the July $61 puts to sell if I'm looking to acquire the stock, and it does the work for you. There's another place that you can also use the OptionsPlay platform to do this as well. It's in the education and resources section here on the upper right-hand corner. When you go to the OptionsPlay hub using this link, you will see a cover call and short put report in this hub. And when you click on the cover call or short put report, it basically gives you a list of all the available opportunities that we scan this current market for, and finds the opportunities that you can use to sell cash secured puts or cover calls. And this really depends on whether or not you have a specific stock in mind, or you're just looking for the highest yield. So for example, if I'm looking at Square right now, Square is currently trading at about $66. But if I sold the $67 cover call, I can collect in this particular 11% of the stock's value in doing so. If I'm looking at Affirm, $21 stock, I sold a $24 strike price. That is one that will collect 11.63% or annualize that to 98%. So this is really a way to give you an idea as far as what stocks in the market are generating the highest amount of yield for cover calls, and doing the same thing here for short puts, so that you can quickly identify opportunities potentially for stocks that you might want to purchase using this type of strategy. And when you click on the link, the symbol here on the right-hand side, it actually brings up the trade for you in OptionsPlay, so that you can actually view this trade here in the OptionsPlay platform. So with that, Jess, what I'll do is I'll pass this back to you for us to take a look at some of the key statistics around options trading.
Happy to do so. And while we're doing that, love throwing out this poll. Just from a percentage basis, how many options percentage-wise do you feel are actually exercised? If you want to type that into the chat. Variety of answers there.
See some pretty good guesses.
Mm-hmm. Okay. I like the substantiating responses as well. So I'll go ahead and share my screen so we can see what those are. But the answer is 7%. 7% are actually exercised. 23% expire worthless. And remember, that could be your intention. You may be profitable at that moment. So know that statistic as well. And then 70%, the vast majority, are actually traded out of the market. So what does that tell us? It's one of the best practices really is closing out your option when it hits your target price. And that means on the profit level and on the loss level. There was a lot of questions about what do I do when I'm at a loss? Well, you definitely don't hold on because that's when things go adversely. And it's very important, even if you're trading purely stocks, but if you are trading, you have to have an exit strategy. And that is inclusive of when you make profits and when you make losses. And when you have a disciplined approach, you're more likely to be successful. And that's very true with the statistics of when options are actually executed upon, expire worthless, or traded on the market. And traded on the market means you buy to close your strategy or you sell to close your strategy. You may roll that strategy even. But at that moment, what that simply means is when your strategy hits either one of those points, which is your max profit or loss. We do have best practices for that, but a lot of that is also your personal risk tolerance. In addition to, you close and you reassess your sentiment. If you're at profit, maybe you want to roll the strategy, at which point that's when you could, in addition, roll it, or perhaps you feel that you need to roll it lower or higher. So those are things of that nature that are really important, and that's why these statistics are helpful and they really drive that point home.
And just to talk about some of the best practices for trading options, I do want to kind of leave this session with some thoughts as to kind of how to proceed forward from what you've learned here today. Jess, if you don't mind just advancing to the next slide. First, we always advocate that you start with education. This is just a good example of what education looks like from an options trading perspective, meaning don't expect to just jump into options trading and try and do a trial by fire. And I know many of you have done that, and I know it's very tempting to do that, especially when you see the type of returns that can be potentially made from certain option strategies. But how many of you can relate to kind of jumping in, hoping to learn as you go along and finding yourself risking substantially more money than you originally intended, or even thinking that you were going to make money, but instead lost money on a specific trade? If you can relate to that, please type 4 into the chat window. And I know I'm going to see a lot of 4s here going across the screen. So the first thing we advocate is understanding your risks. And the best way to do that is just learning about each individual strategy you're trading, whether you're looking at cover calls, cash secured puts, credit spreads, iron condors. There are education on each specific option strategy. Make sure you understand what the risks and rewards are. Make sure you understand what are the best practices of each underlying strategy before you execute them. But more importantly, I would say sizing. This is one of the things that we recently launched in OptionsPlay. And actually, what I'll do is I will share my screen here just to show you that real quick, because I think it's so important to understand position sizing. When you're looking at any specific trade, it doesn't matter whether you're looking at a bullish, bearish, a debit spread, a credit spread, a long put, long call, whatever strategy you're looking at within OptionsPlay, even one that you've created yourself, right? And you can create lots of crazy things that you can do here in OptionsPlay. Whatever you can possibly imagine and create, always use the risk and investment calculator that's built into the platform. And what we have here in the risk and investment calculator is a way to set the defaults in your profile. And I highly recommend, if you haven't done this before yet, go and do it right now as we speak. You go to the risk and investment calculator under your trading tab, and in the risk and investment calculator, there's a button here that says you can adjust your defaults in your profile. So when you go to that, what it gives you is the choice of selecting how much you want to risk on your overall portfolio and the size of your portfolio. Here, I've chosen 2%. I recommend, if you're brand new to options trading, stick to this 2% rule. If you're more experienced, you might change this slightly, but largely the recommended starting point is 2%. I don't have quite enough time to go into the numbers and the math behind why 2% is the rule of thumb here, but this is where we recommend you to start. You then input the size of your portfolio. Here, I'm going to use $100,000 in my particular case, save this as default. And when you use the application, again, no matter what strategy you're looking at, bullish, bearish, debit, credit, iron condor, jade lizard, doesn't matter. We use the risk and investment calculator and simply click on calculate. It already populates for me the amount that I'm willing to risk, which is 2% of a $100,000 portfolio, that's $2,000. And when I click on calculate, it will automatically calculate the number of contracts of whatever strategy I'm looking at. Whether I'm shorting the stock or I'm buying a put option or I'm buying a put vertical, it'll automatically select the number of contracts where my max risk will be roughly or just under $2,000. This is one of the best ways. And I see a lot of traders, in the last question say, I've blown up my account a few times. I've certainly got burned quite a bit. The only way to prevent yourself from being burned is to never trade too large of a size to begin with. If you trade small, you can't get burned. Literally, you cannot, because you've traded sizes that literally limit the amount of losses that you have on the individual trade. So these are some of the things that you can put in place to help you prevent yourself from getting burned, and also put in place proper risk management that's going to help you manage your portfolio size. How many of you have actually used this portfolio tool, this risk and investment calculator, with the settings in your profile? Type yes into the chat window if you have or currently are already using this tool. And if you're not, again, I recommend that you go into your platform right now and set those settings, because you should start getting into the habit of every single time you place a trade, before you place that trade, you click on the calculate button so that you can calculate the number of contracts that you can trade. If I'm looking at selling credit spreads, I want to use the risk and investment calculator and calculate how many contracts I can sell. You want to do this before you place your trades, so that you know exactly how much you are risking. In this particular case, I can sell 4 contracts of the put vertical, and I can sell 8 contracts of the call vertical. And each one of these strategies, my max risk is under the $2,000 mark, which is my risk tolerance on this particular trade. So I know that no matter what happens on this trade, my risk is going to be under the $2,000 threshold. So even if I have the max loss on this trade, I still have 98% of my total portfolio intact to continue trading again. But if, let's say, you risk 10 to 15% of your account per trade, and you do that a couple of times, you're going to blow a very severe hole in your portfolio that's going to be very, very difficult to come back from. So, the next thing that I want to show you guys here is talking about having a sentiment. So whenever you're using an option strategy, the most important thing, the biggest exposure that you have on pretty much every option strategy is going to be the Greek delta. And delta gives you the directional gain or loss on the option itself, which is why you must have a sentiment on the stock before you try to trade an option strategy on the back of it. Make sure you understand whether you think the stock is going to go higher, lower, or sideways, and select a strategy that's appropriate for that directional view that you have. And more importantly, have an exit plan before you get into the trade. I see a lot of traders get into a trade and then kind of figure things out as they go along. And that's usually where you start to build behavior that can lead to some huge losses, because you don't have an exit plan and things aren't going so well. So you try some desperate things to try to get yourself back to break even, or try to get yourself to not have such a large loss. And next thing you know, you may have committed way more capital than you originally intended, and have, many times when people refer to blowing up their accounts, it's usually these types of strategies that cause you to do so. And lastly, use the tools and resources that are available to you. There are a ton available to you here at OptionsPlay. Today, I just showed you a handful of it, the tools that are designed to help you select your expiration date and strike prices for you so you don't make mistakes along there. Make sure you analyze the risk and reward using the OptionsPlay platform, and use the proper calculators to help you calculate the number of contracts. These are all tools to help you implement the strategies that you've learned here today and help you stay in your lane. With that, for those of you that are brand new to OptionsPlay, if you do not have access to what I just showed you here today, you can sign up for a free 30-day trial at optionsplay.com. Gives you access to our weekly global macro research that we send out on Mondays to give you a framework of what's happening over the next week or so, daily trading signals that we send out with specific entry and exit trades on swing trades and day trades and macro trades that we make using options, and even access to some of our longer term ideas like the one that we put out this morning here on gold. So these are all available to you for 30 days for free at optionsplay.com. And we now have a mobile platform for those of you that are looking to trade on the go. And if you don't, what you can do is you can literally point your phone's camera at that QR code on your screen. If you have not downloaded the mobile platform, I recommend that you do that. We have a lot of features coming out on the new on the mobile platform in the next couple of months. So make sure that you have access to it so that you can track your portfolio, find some of the new trade ideas that we're sending out on the go using your OptionsPlay mobile platform. So with that, I just want to thank you for your time here this afternoon. And Jess, I know she does as well. So what we will do here is spend a few minutes answering your questions from today's session. No questions are off the table. Feel free to ask your options related questions, either from things that you've learned from today's session or just your general options questions. And we'll try to answer as many of them as possible before we have to sign off here for today.
Mm-hmm. And I saw a lot related to I don't want to get assigned or things like that. So we shared with you best practices for utilizing cash covered puts to buy stocks and covered calls, because those are really, really common strategies, especially from the income side. But no, if you don't want to be assigned, then you just adjust your strikes. So you would do something a little farther out of the money. And that just goes into the deltas as well. They're actually going to work identical, if you will. You can utilize delta to maybe find a little more, but if you don't want to be assigned, if you have something that's farther out of the money, it's going to have a lower delta. So there's two ways to look at it to give an indication if the probability of assignment is something to care for. And know that if you are selling cash covered puts to buy stocks, that's why you would do it closer to the money, which will have a delta of 0.5, because it's going to either go move $1, be in the money, or move $1 and go out of the money. So 50% probability of it being in the money. That's the logic there. So if you want something that has a lower probability of being in the money, you need a lower delta.
Yeah, and that's a good transition to the question here from Patrick, which is, what's the desired delta for cover call strike price? So we've basically back tested this, everything from 50 delta all the way to basically 2 delta. And from our perspective, anything higher than about a 15 delta, you are giving away too much upside in exchange for some extra premium or extra income, if you will. If you choose something like a 30 delta, you're going to get a nice fat juicy premium, but you're giving away more upside than what that extra premium you're going to collect. So we tend to find that 15 is about as high as you can go. 10 to 15 is kind of your sweet spot for selling cover calls. That answered the question for quite a few of this. Mm-hmm. Bill is asking a good question. He's saying, would the trend not affect your strike price selection? And I think when we're referring to things like a cover call or a cash secured put, there always can be a tactical element to selecting your strike prices. So for example, yesterday on CNBC, I highlighted the fact that someone sold a really close to the money cover call on Gilead. So this person, based on the size of what they sold, likely what has an equity position, about a $71 million equity position in Gilead. So obviously someone fairly well informed, clearly institutional money. And what they did is they sold in this particular case, I think it was a September 62.5 strike cover call. So basically an at the money cover call all the way going out to September. So this is an example of a tactical play from a cover call perspective, because this investor is giving away all upside in this stock from now all the way through September in exchange for about $2 a share. That's about 3% of the stock's value. They're basically saying, I'd rather take 3% today over the next 90 days because I don't think the stock's going to rally by more than 3% or more over the next 90 days. Otherwise, they wouldn't do it. So this is an example of where you can take a tactical approach. I will say, from a probability-based perspective, this is one that doesn't work out for you in the long run. But absolutely, if you have a directional view, you can use it to select your strike prices. It's just that when you don't necessarily have a directional view, these are the optimal strike prices to use. So hopefully that answered your question, Bill. It's a great question.
Lucas asks about, I guess, an extension of the previous question, which is assigned early. So I always say, look at that through the perspective of the long option holder. If it makes sense for them to exercise, your probability of assignment is higher. So normally that's when your option is very deep in the money, or perhaps there is an ex-dividend date coming up, there's a short call. And it can also happen after hours on the day of expiration as well. We have a webinar that goes on all about assignment and expiration and some of the even nuances that can happen and one-off circumstances that we shared with you, in addition to what your brokerage firm does on the day of expiration to protect you from risk in those type of circumstances. So that's important. But rule of thumb, the only way to prevent assignment is by not holding a short option. So meaning closing it out. And that's why that exit strategy is extremely important, because you're going to do that when you're profitable or to minimize your losses. But the likelihood of assignment is really on the person who has the ability to execute upon the terms of the contract, which is the long option holder.
Exactly. Patrick had a follow-up question as far as what is the desired delta for a cash secured put from us. Usually the 30 to 40 delta strike price is the starting point. So when you use the OptionsPlay hub, the strike prices are selected on the cover calls, about a 15 delta, short puts, about a 40 delta. So we apply what we're teaching you here in these reports. So when you're using these reports, you can expect that those strike prices align with those deltas. What about the invest selector for income? Not sure I understand the question. If you don't mind clarifying, I'm happy to answer that question. Michael's asking a great question. He's saying, how does the risk and investment calculator work with the strategy with unlimited risk, such as a short strangle or short straddle? Great question. Let's bring up a short straddle. And the reason he's asking this is because the max risk is unlimited, right? How do you select and how many contracts that you sell when something has unlimited risk? Well, what we do is we look at how much you can potentially lose if the stock has a 2 standard deviation move against you, or it has a 2 standard deviation move against you in either direction. As you can see, if the stock moves 2 standard deviations down, you have a loss here of about $1,800 when you sold 2 contracts. So that's how we select how many contracts you can trade, if you will, on something with unlimited risk. In this particular case, we're basically saying in kind of a scenario where things move significantly more than you expect it to. So we expect 95% of the time, the stock will be between these 2 prices, which for Gilead currently trading at 62, 95% of the time, the stock will be between 51 and 75 by the August expiration. So if we model kind of a bad scenario where the stock declines down to 51, you're still within the $2,000 loss range. That's how we select how many contracts you can trade with a strategy that has unlimited risk. Great question, Michael. Oh, and Mike asked the same question actually as well. So I saw a couple of questions here asking how many trades can you establish with the 2% rule? Kevin, that depends, I would say, a little bit on kind of how well diversified your positions are. Meaning, if let's say you just simply take a 2% position, you take a long position in Apple, long position in Meta, long position in Google, long position in Amazon and Netflix, and these are all very heavily correlated tech stocks that you have long positions in, then I would say not many. But if let's say you have a good variety of long and short across different sectors, you have some long energy, you have some short tech, you have some, look at the sector watch list. For example, if you have a sector watch list and you sort it based on the relative strength, you can see that communications, technology, and discretionary are weak sectors. So perhaps, these are the sectors that you have some short positions in. You look at some of the strong sectors like healthcare, utilities, and staples. These are some of the positions that you have long positions in, and you have a good variety of balance between the sectors, then you can have more. So it really just depends on how concentrated your positions are. If you have a very concentrated position, you probably don't want to have more than 4 to 5 open positions at once. But if let's say you have a good diversification, you could probably get close to about 10, 12 open trades at a time. So it just depends on where on the spectrum you are, but somewhere between 5 to 10 trades using the 2% rule open at one
time. Going back to the Greeks, there is a question on what is delta, and Peter asked about, can you gamma? I just like the way that question's worded. So I'm happy to explain that. So delta, we mentioned it a couple times and with a couple of different ways. So delta is on a scale from -1 to +1. We've been saying that it's going to define your directional movement. So if it's at +1, anything positive is a bullish strategy. Anything with a -1 is a bearish strategy. Your goal, if you're buying the option, is to get it to either end of the spectrum, whichever, depending if you're bullish or bearish. And then the inverse is true if you're short the options. Gamma is the acceleration. So think of that. If you have a long option and your goal, or a long call, let's use something very specific, your goal is for the stock to go up as much as possible. As the stock goes up as much as possible, that means delta is going to get closer to 1. Gamma tells you the acceleration at which that's going to happen. So gamma is the its job is to get delta to either 0 or 1. So gamma is centered around at the money options. It goes higher as you get closer to expiration. And there's a lot of mechanics that go on with it, but we utilize delta to tell us the directional movement that's needed. So if you combine strategies, it reveals if it's a positive or a negative delta. And that may be something that you need if you're looking at a long call and a long put together, a straddle, for example. We also utilize it to find the probability if we're going to be in the money or not at expiration. And that's something that's important if you're concerned about assignment and you're taking care for a capital appreciation when writing covered calls or anything really income related. And then gamma is something that is risk for short option sellers and can be beneficial for long option holders, because if gamma is telling us how quickly we're going to get delta to our ideal state for either one, to be honest, a higher gamma is going to benefit something that needs a sharp movement. So that's when we were saying really, really early in the presentation where we actually explained all of the Greeks. We just never, they have names, but we explained concepts that were associated with the individual securities. We have a very, very long hour, I think we ended up going an hour and a half on that one, but webinar on the Greeks on the YouTube channel. So I'll put that in the chat. And then I'm also going to put the exercise and assignment video in the chat as well, because I saw a lot of questions on what my firm does and things of that nature as well. And that varies by firm. But the Greeks are important to understand foundationally. But what I do want you to take away is a lot of those are used to define starting points. And that's the purpose of the OptionsPlay tool. You don't have to know all of that. It already picks those optimal ones for you. We've already back tested that. We've already done that legwork. It's great to know if you want to modify and adjust and as you advance in your options trading, but know the best ideal outcome for each individual strategy is already selected for you when you utilize the tool.
Yeah, and I'm just going to do a quick rapid fire of some questions here. Ravinder, your question about the smallest time frame for charts, the answer is yes. Paul's question about using a 10-put spread against when it goes against me, how close to the higher price should I close the trade? Paul, we tend to not think of it necessarily from a distance from the strike price per se, but from a loss perspective. If you sold the put spread, once you lose about 100% of the premium that you've collected, that's about time to start cutting losses on the particular trade. A question about strength number in trade ideas. So when you look at the trade ideas number, you see a strength number here. This corresponds to the relative strength number that you see here on your platform. So the relative strength number is basically telling you how strong the stock is relative to the market. 10 are the strongest stocks relative to the market. 1 are the weakest stocks relative to the market. So if you're looking for bullish opportunities, we tend to lean towards higher scores. If you're looking for bearish opportunities, you tend to lean towards lower scores. And Nash asked a question about looking for expiration dates on Thinkorswim about the July 29th expiration. Nash, I'm not sure where you're looking, but if you look at the options chain, I clearly see the July 29th expiration here. You just have to scroll down or up depending on where you are in the options chain. The July 29th are the weeklies. Those are highlighted in yellow. You should be able to see that right here on your Thinkorswim platform. Any other questions, Jess, that you think we can answer before we jump off? We have 2 more minutes.
I just need to post the exercise in the assignment 1. And thank you, Chris, for the nice compliment. I appreciate that.
There's a question about how do you evaluate IV rank for trades? So, IV rank is a bit of an overgeneralization sometimes of volatility, but as just a high level general rule of thumb, when IV rank is relatively low, you look at buying option strategies like buying a put for a bearish play or buying a put spread for a bullish play. And my computer just froze. And then vice versa, if let's say you are looking for when IV rank is high, you can then use a high implied volatility strategy. So it really just depends on what type of option strategy you choose based on the IV rank. The higher the IV rank, the more you prefer selling. The lower the IV rank, the more you prefer buying an option. There is a video about cloud technicals that Rick and I actually hosted a couple of months ago. I'll just find that and post it into the chat window.
I'm looking for any other questions while you do that. I think we covered them.
If I can get this video to load, here we go. All right, just posted a link here into the chat window for the webinar that we recently hosted on that Ichimoku cloud. For those of you that want to learn a bit more, I know a lot of Rick's work revolves around that cloud model. It's really useful, especially on the daily and weekly charts, to get a sense for where buying and selling tends to accumulate. And it's a really good introduction to cloud charts if you're brand new. So with that takes up to our full hour mark. I just want to thank everyone for taking the time out here this afternoon. I really hope that this was useful in giving you a better understanding as to how to utilize OptionsPlay, what are some best practices around these types of strategies, and giving you a better understanding of how to navigate our platform. So with that, thank you so much. Have a great evening. And Jessica, thank you so much again for your time this afternoon.
Yeah, thank you, everyone.